time. We were doing income tax and we are done with the current tax. We were about looking at deferred tax. We did the introduction. Then we are here to go into the deferred tax itself. The deferred tax itself. All right. So last time I did an example. I put an example over there that let's assume we have our accounting profits to be, and also have our taxable profits. So let's have the profit for the year. So let's assume this is 2021. This is 2022. This is 2021. This is 2022. Okay. So all things being equal, the profit are the same for all of them. The profits are the same for all of them. The profit are the same for all of them. But we have an asset. We have an asset where the value is 4,000 and then company is charging a depreciation of 2 years, where the tax authority is giving capital allowance of 3,000 in the first year and 1,000 Ghana cedis in the second year. So let's assume that all these profits over here are profits before depreciation. So for us to know the profits after depreciation for each of these, we separate the depreciation, which is what the company will be depreciating the 4,000 over 2 years. So each year will be 2,000. Each year will be 2,000. So 2022 also be 2,000. This will also be 2,000. But the first year, the tax authority is giving a capital allowance of 3,000. So the first year will be 3,000. That is the capital allowance. The third year will be 1,000. The third year will be 1,000. So let's look at our profit after tax for each year. The profit after tax will be 8,000. The profit after depreciation will be 8,000, 7,000 over here, and 9,000 over here. All right. Our tax is 25%. 25%. Our tax is 25%. So what will be the tax for 2021 under accounting profits? What will be the tax for the first year?
2,000.
It will be
2,000.
2,000. Okay. It will be 2,000. The second year also will be what?
The same 2,000.
Okay. For taxable profit, 2021 will be how much?
Will be 1,750.
1,750.
50.
Okay. Then the 2022 will be how much?
2,250.
It will be
2,250.
2,250.
50.
Okay. So what will be the profit after tax for this? This will be 6,000, isn't it?
Sure.
This will also be Joyce.
Hello.
Yeah.
Please, what are we doing?
Is that?
What are we doing?
Please, what are we doing?
We are doing deferred tax.
Is it a question you solved last time and you couldn't complete?
No, we didn't start any question on deferred tax. I'm just doing an introduction of what we call deferred tax.
Okay.
All right. Okay. This will also be 6,000. Okay. So under this, what will be the profit after tax?
5250.
5250.
50.
Okay. Under this will be what?
6750.
6750. Okay. All right. What can you see about the tax rates? What is happening to the tax rates? What is happening to the tax here?
Decreased and then increased.
The tax for this one is what?
2000.
The tax for accounting profit is what?
2000.
2000. And how much are we paying here?
1750. Okay.
1750. Okay.
Okay.
What is happening to the profit here?
It's 2000, but it's increased.
The profit over here is 6,000, isn't it?
Sure.
And the profit under this one is what?
5250.
Okay. What is the difference?
750.
750. Okay. A minute. Okay. So what, in actual sense, what should have been the tax that we have to pay? In actual sense, what should have been the tax that we have to pay for 2021?
1750.
1,750, isn't it?
Sure.
But how much are we saying that we are going to pay?
2000.
So what do you have to do? What do you have to do? We have to subtract 250 from the 2,000, isn't it?
Sure.
To make it 1,750. Okay. What is happening here? What is the capital allowance given for 2021?
3,000.
And what is the depreciation that we charge?
2,000.
1,000. Okay. Apply the tax rate on that 1,000 and see something.
It's 250.
It's 250, isn't it?
Yes.
What's the difference between the two tax figures for 2021 and 2021 for accounting and the taxable profit?
250.
It's 250, isn't it?
Yes.
You see the 250 that the tax authority is giving to you right now. You are assuming that that will be given to you in the future. That is why you are not making provision for that 250. So the 1,000 portion, the excess 1,000 portion that you are enjoying today, or the excess 1,000 that they are giving to you on top of your depreciation that you are enjoying today, in the future, that particular 1,000 will not be given to you. But you are making provision that the 1,000 will still be given to you. That's why you are saying that depreciation for 2022 will still be what? 2,000. But that will not be 2,000, that will be 1,000. So what we do is that, okay, under normal circumstance, the tax that we're supposed to pay is supposed to be 1,750, but we are projecting for what? 2,000. What do we have to do? We have to come and subtract a figure so that we can be on the same line with the 1,750. And that figure will be 250, isn't it?
Sure.
The figure that we are going to subtract from 2,000 will be 250, isn't it?
Yeah.
All right. So you can see that the difference between the depreciation and the capital allowance is what? The difference between the depreciation and capital allowance is what?
1,000.
Is 1,000. If you apply tax rate on it, what are you getting?
250.
250. This 250 is what we call the deferred tax. Is what we call the deferred tax. Okay. What is going to happen is that today you are going to pay 750, but in the future, how much are you paying? 2022, how much tax are you paying?
2,250.
You are paying more than what you are projecting by how much? The 250, isn't it?
Sure.
Yes.
Yeah, that is what they call the deferred tax. That is basically what we call deferred tax. What we are enjoying today. What we are enjoying today, but we shouldn't have enjoyed it today. We should have been in the future. That is basically what we call the deferred tax. So the difference, what is causing the difference between your accounting profit, the tax that you are paying on your accounting profit, and the tax that you're supposed to pay on your taxable profit? What is causing the difference? There can be some items that are allowable for tax purposes, but the entity and the tax authority are treating this particular item separately. Maybe if you have computers, the tax law says that the computer is going to be charged on 40% using reducing balance method. But you are saying that this particular computer, you are going to use it for 5 years. It will happen that the capital allowance and the depreciation that you are charging the same computer will not be the same. And in that case, that will create an issue of the tax on the accounting profit being different from the tax on the taxable profits. And that will always cause issue. That will always cause things that we call the deferred tax. So deferred tax, we are just looking at what are those issues that are causing the difference between the tax that we are going to pay on our accounting profits and also the tax that we are paying on our taxable profits. What are those things that are causing the difference? The first one can be depreciation. Any item that is allowable for tax purposes but are being treated for different periods by the company and the tax authority will always create issue for deferred tax. But those issues that are not, or those items that are not allowable for tax purposes, example is penalties and fines. If the ignorance of the law is not an excuse. If they say you should file your pay before 15 of every month, 15th of the subsequent month, you are not doing the tax authority charge you a penalty. You are going to subtract that as an expense, but the tax authority is not going to allow you to deduct that for tax purposes. These are some things that will happen and they do not create any tax implications. They are not allowable for tax purposes. But the only items that are allowable for tax purposes are the things that we take into consideration for deferred tax. So basically, if you want to understand deferred tax, this is the idea about the deferred tax. What is causing the difference? We make provision for that. So you can see that today the tax authority is giving you 1,750, but you are saying that you are going to pay 2,000. You are enjoying 250 in excess because you are projecting for 2,000. You are paying 1,750. You are enjoying 250 in excess, and you are happy. 2022, you are providing for 2,000, and the tax authority is giving you what? 2,250. You are paying 250 in excess. It is the 250 that you enjoy already that you are paying in the future. So what we do is that let's make provision for the 250 that we are going to pay and reduce it to the amount that we are paying, so that if it comes available, we add it and pay. That's all about the deferred tax. All right. So we are going to look at the causes of deferred tax. Basically, we have two causes, the differences. We have the temporary differences and permanent differences. In making provision for deferred tax, we use only temporary differences. What do we call temporary differences? Temporary differences arise when an expense is allowable for both tax and accounting purposes, but within different accounting periods. So that I said about computer, a tax law says that computer should be depreciated at 40% using what? Reducing balance method, those doing advanced tax. Is that not for computer and any other hardware? It's not 40%. Advanced tax people, computer and any other hardware is not 40% on reducing balance method. Baby now is not 40%. Steve. Stefano.
Yes, sir.
Capital allowance for computer and other hardware is not 40% on reducing balance method.
40%. 40%.
It's 40%,
Yes.
isn't it?
Yes, yes.
Yes.
All right.
That's it.
Okay, so the computer should be 40%, and you are saying that the computer is going to last for 10 years. What is happening? There will be a difference between the capital allowance and the depreciation, isn't it?
Yes, it is.
Yes.
And in that case, that will create a tax what? Consequences. So if the item is allowable for tax purposes before the tax authority and the entity are treating it differently, the difference between them will cause a tax implication. There will be a tax implication from the difference. So in that case, let's make provision for that particular tax implication that we are going to incur in the future. That is all about the deferred tax. So depreciation is also one of the items that will cause the difference between the accounting profit and the taxable profit. Depreciation is first, and it's also part of the temporary differences. So any item that is allowable for tax purposes, but the tax authority and then the entity are treating it differently. If you come to research and development expenditure, if a company incurs research and development expenditure, the tax authority is going to write it off in the year in which they incur that particular expenditure. But what the entity is going to do is that the entity is going to capitalize this research and development expenditure and amortize it. So if the research and expenditure, the expenses that they incur is 40,000, okay, the tax authority will deduct this from the profit of the company before they will charge the tax. But the company is going to capitalize the 40,000 and be amortizing it over the life of the products. So what is going to happen is that the company is going to enjoy all the tax on the 40,000 today, but they will be thinking that they will be paying the tax on this one in a bit. So maybe in the future, this 40,000 that they are enjoying today will not be there for them. So they are going to pay the tax benefit that they have enjoyed today in the future. So let's make provision for that particular tax that we are going to pay in the future. That is a deferred tax. So research and development expenditure will also cause a deferred tax issues because it is allowable for tax purposes. Let's come to another item. Okay, what do we call temporary differences? They are the difference between the carrying amount of an asset in the financial statements and also the tax base. So the temporary difference, how do we calculate it? It is the difference between the carrying amount of the assets or the liability in the statement of financial position and its tax base. Okay. You can also use the depreciation or the capital allowance. Let's come to the first example that I used. What was the value of the asset? The value of the asset was 4,000, isn't it? The company charged depreciation of what? 2,000. What would be the carrying value? 2,000. The value was 4,000. The tax authority give capital allowance of what? 3,000. What would be the carrying value? 1,000. So the difference between the carrying value and the tax base is now what?
1,000.
Is 1,000, which can also be gotten as the capital allowance minus the depreciation. But what we normally do is that for temporary differences, we can't go to statement of profit or loss and be looking at the tax that we are paying and also the depreciation that we are charging. So we use what we call the liability method. So temporary difference is equal to the carrying amount of the asset minus the tax base. The tax base is the carrying amount of the entity's asset in the books of the tax authority. It is the same as the carrying amount. But in the case of the tax authority, it is called tax base. How do
Okay.
we calculate tax base? Is the cost of the asset less accumulated capital allowances. That is in the books of the tax authority. But the carrying value is the same as the cost minus the accumulated depreciation less any other impairment. That is for the carrying value of the asset. So if you want to find temporal differences is gotten as the carrying amount of the asset in the books of the company minus the tax base. You can also use the depreciation capital allowance to calculate that, but we normally use the liability method, which we use the carrying value and then the tax base. That is the temporary difference. How then do we calculate deferred tax? Deferred tax is calculated as tax rates. You can see that what we do over here is that we apply the 0.25 on the difference, which is 1,000, and we got the 250, which is the benefit that they are enjoying. So what we do is that deferred tax is calculated as the tax rates multiplied by the temporary difference. Deferred tax is calculated as a temporary difference. Deferred tax can either be a tax deductible or taxable figure. It can be deductible temporary difference, or it can also be what we call taxable difference. We look at what we call the taxable difference. So this is how we calculate deferred tax. The tax rate multiplied by the temporary difference. And this can be tax deductible, or it can be taxable difference. It can be deductible difference or taxable difference. But I will explain what we call the deductible difference and taxable difference. Okay. Let's come here. Okay. Assuming it is the company that is charging a depreciation of 3,000, it means that their profit will be what? 7,000. Okay. Then they will now come and charge 3,000 over here. Okay, let me keep the company one. Let me keep their one. Okay. Okay. So what is the tax that we are saying that we are going to pay? It's 2,000 for the company. For the tax authority is what?
1,750.
So it means that they are giving us what? 250. We are enjoying a benefit of 250, isn't it?
Yes.
We're enjoying this benefit because the capital allowance is higher than what?
Depreciation.
The depreciation, isn't it? So what do we have to do? What do we have to do to make the tax 1,750 here? What do we have to do to make the tax 1,750 there?
Deduct the difference, 250.
We have to subtract the 250 from it, isn't it?
Yes.
All right. So whenever the tax authority is giving more, or the tax base is higher than the carrying value of the asset, we say that is a taxable difference. When the tax base is higher, when the tax base is lower than the carrying amount of the asset, or if the carrying amount of the asset is higher than the tax base, we say that is carrying value is higher than what is my higher than? Okay, it's higher than the tax base. When the carrying value is higher than the tax base, we say that is a taxable difference. Therefore, we subtract it from, we treat it as an expense. As an expense. So you can see that the companies, the tax authority is giving a higher capital allowance. Therefore, their tax is lower. So what we have to do is that we have to subtract the 250 from the 2,000 to now make it what? 1,750. Let's count to 2022. Let's count to the 2022. 2022, what are we doing? We are charging 2,000, isn't it?
Yes.
The tax authority is charging what?
1,000.
What is the tax that we are paying?
2,250.
Okay, but what is the tax that we are saying that we are going to pay?
2,000.
2,000.
So what do we do there?
Is
What do we do there?
subtract
We add the 250.
We add the 250, isn't it?
the 250. Okay, all right.
Right. Okay. We add the 250. Okay. So whenever the carrying amount is okay. In these two cases, they are all higher. The carrying amount is all higher. Okay. This example cannot go. Okay, let me just put it here. Whenever the carrying value is lower than the tax base, what we do is that this is called deductible difference. Deductible difference. And if it's taxable difference, it's treated as a liability. It's treated as a liability. Then we are going to have deferred tax liability. Deferred tax liability. When it is deductible, then this will be treated as a deferred tax asset. This will be treated as a deferred tax asset. All of them will be classified as long-term items. Long-term items, because the asset will be used for more than 50 years. So we start making the provision to up to the useful life of the asset. So when the carrying value is higher than the tax base, we call that one taxable difference. It means that the tax authority is giving more to the company, and the company is going to pay that particular one in the future. So the company has to make provision for that as a liability, as a provision. So that will be an expense. If it is deductible, it means that the carrying value, the company is charging higher than the tax base. So it means that the company is subtracting a figure which the company is going to be given in the future by the tax authority. So the company is going to enjoy some benefit in the future, and that is deductible difference. We treat it as an asset, deferred tax asset, also non-current assets. All right. Okay, these are some of the examples of temporary differences. Any item that is allowable for tax purposes will cause what we call temporary differences. Let's come to permanent differences. Permanent differences are those items that are not allowable for tax purposes, but it happens once in a while. Example will be entertainment expenses. Entertainment expenses are not allowable for tax purposes. When you incur it, you will either suffer the tax consequences for that particular year, and that is the end. It will not create any future tax issues. So any expenses that are not allowable for tax purposes will not cause anything that we call deferred tax. Will not cause anything that we call deferred tax. But those items that are allowable for tax purposes, but for different periods, are what we call the temporary differences, and those are the items that will cause what we call deferred tax. Those are the items that we call deferred tax. How do we calculate deferred tax? I have said that already. It is the tax rate multiplied by the temporary difference. How do we calculate the temporary difference? It is the carrying amount of the asset less the tax base of the asset. That is the temporary difference. So that is basically how we calculate the temporary difference. So if the carrying value is higher than the tax base, this is a taxable temporary differences and results in a deferred tax liability. I've said that already. If the tax base is higher than the carrying value, this is a deductible temporary difference and results in a deferred tax assets. All right. If the difference between the carrying amount of an asset or liability in the statement of financial position and each tax base is caused by a permanent difference, it does not create a deferred tax. The entity must bear the increased tax charge or giving a tax credit. That is all. Those items that are not allowable for tax purposes will not create anything like deferred tax. If you write goodwill off, the tax authority does not recognize goodwill for you. If you amortize goodwill, if you have incur impairment on goodwill, goodwill is not considered for deduction for any tax issues. So whether you have a goodwill, you impair goodwill is not allowable for tax purposes. So you can't create deferred tax on the goodwill. If you pay penalties for you not complying with the laws of the state, penalties are not allowable for tax purposes. So it will not create any deferred tax issue. How do we calculate deferred tax? Deferred tax is calculated as tax rate multiplied by the temporary difference. Deferred tax is treated as an expense, it's a provision, and it will be treated as a long-term liability or asset. It will be treated as a long-term liability or asset. Deferred tax is treated as a provision. So increase or decrease has to be taken into consideration. So if you have the first one to be 12,000, the next provision that you made was 15,000, we only take the increase. It means that the total amount should have been 15,000, but you have charged 12,000 already. So you need to add 3,000 to make it 15,000. So we look at only the difference. It's treated as provision for bad debts. Deferred tax is treated as a provision for bad debts or any other provision. So if you have 12,000 at the beginning, you now have 15,000. It means that this has increased by 3,000. So we only charge the 3,000. So we go and add a 3,000 to 12,000 to now make it 15,000. Deferred tax is treated as a provision like any other provision, So what we are going to do is that let's pick a question. Then we look at how to go about deferred tax. Let's pick the question 1. Okay, question 1, the answer is there. Let's forget about the question 1. I've solved that one in the note already. Let's go to another question. Okay. Before I will continue, deferred tax is adjusted against current tax. Deferred tax is adjusted against current tax. If the deferred tax is increasing, it means that you pay more. So you go and add it to the current tax. Let me pick a question that will be that there is no solution to it, that we move on. Okay. Let's look at question 3. Question 3. Who is reading for us? Question 3.
I can't see where the question is. I don't know.
You can't see the question. Can you see the question now? Question 3.
Yes, we can see.
Yes, I can see.
Okay, who is reading for us?
Okay, let me read. Question 3. I read.
Okay.
The Links Limited is an agro-processing company which operates under International Financial Reporting Standards, IFRS, and prepares the financial statements up to the 31st December each year. The company intends to comply fully with IAS 12. income taxes by introducing what? I can't see. I'm using a phone, so it's just smaller in my eyes.
Okay,
Oh, so let me help. The Links Limited is an agro-processing company which reports under international financial reporting standards and prepares its financial statement up to 31st December each year. The company intends to comply fully with IAS 12 income taxes by introducing deferred tax in its financial statement. On 1st January 2020, the company acquired an item of plant which cost 750,000 Ghana cedis and has a useful life of 5 years with no residual value. The Links Limited enjoys capital allowance at the rate of 30%. The revenue generated by using the plant is taxable. Any gain on disposal of the plant will be taxable, and any loss on disposal will be deductible for tax purposes. The Links Limited estimate current tax provision for the year to 31st December 2020 at 10,125 Ghana cedis. The tax rate of the Links Limited is 25%. Required. A. In accordance with IAS 12 income taxes, explain the amount to be reported in the Statement of Financial Position and Statement of Profit or Loss for the year ended 31st December 2020. B. Explain the temporal difference and state one circumstance in which temporal difference may arise.
okay. So this particular thing, they are saying that the Links purchase plant, isn't it, which costs what, 75,000 and has a useful life of 5 years with no residual value. The company enjoys capital allowance at a rate of what, 30%. And for how many years the company is saying that they are going to use the assets?
5 years.
5 years.
Yes.
So if you change the 5 years to percentage, what will be the percentage there?
20%.
That would be 20%.
20%.
So you are giving 30% as capital allowance, isn't it? You are giving 30% as capital allowance, but you are charging what? 20% depreciation. What is happening? You can see that the difference, there will be a difference, isn't it?
Sure.
Yes.
What will be the difference there?
10%.
10%, isn't it?
Sure.
So it means that 10% portion over there, you are enjoying that as a benefit today, which you are going to pay for it in the future. So that 10%, make provision for it. That 10% that you are enjoying today will not be given to you in the future. Therefore, you are going to pay more tax for that. So make provision for that 10%. But since there's a difference between the depreciation rate and then the capital allowance rate, definitely there will be an issue of capital allowance. There will be an issue of deferred tax because this plant in particular is allowable for tax purposes. Depreciation on it is allowable for what? Tax purposes. So when the capital allowance and the depreciation are different, there will always be an issue of deferred tax. But how do we go about that? How do we go about that? We say that deferred tax is calculated as what? Deferred tax is equal to
Tax rate
the tax rate times what?
and the temporary difference.
Times the temporary difference. How do we calculate the temporary difference?
The difference is with the carrying value and the tax base.
So
Tax base,
in
yes.
this case, we have to find the carrying value of the asset and also the tax base, isn't it?
Okay.
Yes.
When was the asset bought?
First January.
2020. When are we reporting?
31st December.
How many years after purchase?
1 year.
Exactly 1 year.
So it means that after the end of the 1 year, then we do the difference. So we have that carrying value is equal to, then you can do, if you like, you can do 20% times the cost. Or you can do the cost divided by what? 5 years, anyhow you want to do it. So 750,000 divided by 5 years. What will be the depreciation? Okay, carrying amount will be the total cost minus the accumulated depreciation, isn't it?
Yes.
750,000. Shit. 750,000 minus into brackets. So what will be the depreciation every year?
150,000.
So if you subtract it from that, it will be 750 minus 150, isn't it?
So that's 600,000.
Minus 150,000. That will give us 600,000.
600.
600,000.
Yes.
600,000. So we need to find the tax base now, isn't it?
Yes.
Okay. Tax base is equal to the cost of the asset minus the capital allowance. So the cost is 750,000 minus capital allowance is 30%, isn't it?
Yes.
Times the cost, which is 750. How much are we getting?
Due to 5,000.
750 minus what?
You get 325,000.
225,000. Okay.
Yes.
So if you subtract, what are you getting?
Five two five
I get
thousand.
525.
525,000, isn't it?
Sure.
Yes.
All right. So what is happening? Our temporary difference will be what? Will be the current amount
75,000.
minus what? 525,000, isn't it?
Yes.
So what is happening? Is it taxable or is deductible?
The deductible.
So our deferred tax will
Taxable.
now be
It's taxable.
0.25 times what? Times the difference, which is 75,000, isn't it?
Mhm.
75,000. So what will be the figure there?
Eighteen 750.
18,700 what?
18 750. 750.
Okay, that is our deferred tax, isn't it?
Sure.
All right. Let me show you something too again. If you look at the question, the depreciation rate is 20%, isn't it?
Sure.
The
Yes.
capital allowance is what?
30%.
So it means
30%.
that the tax base will be lower than the current amount by 10% of the cost, isn't it?
Sure.
Yes.
Find 10% of the cost, let's see something.
That would be 75,000.
So you can find the temporary difference by that one, the difference between the rates. Then you just multiply it on the cost. That is the temporary difference. Another way of finding the temporary difference is what is the depreciation? What is the accounting depreciation? It's 150,000, isn't it?
Yes.
What is the capital allowance? What is the
325.
capital allowance?
325.
225. The difference is what?
75.
So you can also find a temporary difference by that. But what we normally use that we use the liability method, which is the carrying value less the tax what? Base.
Yeah.
Carrying value less the tax base. Okay. It means that
Please, can you come again? Please, in a-
we use the liability method, which is the carrying value less the tax base. But the figure, all that I've shown you right now is what we use as the statement of profit or loss. That is the method. We look at it from the statement of profit or loss side. But the one that I'm giving to you right now is we look at it from the balance sheet side, the statement of financial position, which is the liability method. Okay. So the liability method is the carrying value less your tax base. All right. What is happening is that the company is going to that portion of the tax, a tax relating to 75,000 for the company will not pay it now. The tax rate is 25%, isn't it? So if the tax authority is charging their tax, the 75,000, which is a difference, the company will not pay tax on that particular one now, but that particular tax will be paid in the future. Because this 75,000 are the difference, the tax authority is not going to subtract it again. They have already subtracted it. So this will not be taken from the chargeable income of the company or the accessible income of the company again, because it has already been taken. So the company will be expected to pay the tax of 18750. So what will happen is that this thing that we are going to pay in the future, let's make provision for it now. This is an expense to us. Since we are going to pay, this will be an expense to us, isn't it? Since it's an expense to us, what will be the effect of this on our profits?
It will reduce the profit.
It will reduce the profits. What is the effect of current tax on our profits?
Reduce.
It will also reduce it.
So what we do is that we just come and add the, if the deferred tax we are going to pay in the future, then we add it to our current tax. But if it is the tax authority who is going to give us money because we are charging more depreciation, it means that the tax authority is giving us low, but our accounting profit is now high. It means that they are going to give us more capital allowance in the future. So therefore, we have to enjoy that particular part. So we normally adjust the deferred tax against the current tax. What is the current estimate? What is the current year estimate? It's 10,125. So 10,125, we come and add the deferred tax to it. We come and add the deferred tax to that particular one, which is the 18,750. So in your statement of profit or loss, you are going to have these two figures as the current tax, which is 28. This. You are going to have these two figures as the current tax. Okay. Assuming we have a previous balance on the deferred tax. We have a previous balance on deferred tax, which was 15,000. That is at the beginning of the year, there was a previous balance on the deferred tax. How much are we going to charge now to the current tax? If we have an opening balance of 15,000 on deferred tax, how much are we going to charge now to the current tax?
We subtract it before.
3,750.
3,750, because it is a provision. Our new provision now is 18,750. So we only take the movement, the difference. It means that our provision has increased by 3,750. So we go and add the 3,750 to the current tax. But this is our first provision. There's no previous balance. So the first one, all of them will be added to the current tax. Okay, so in the statement of profit or loss, your current tax will be 28,875. How would the current tax be shown in the statement of financial position? Is it a liability? Is it going to be a liability? Current tax, is it a liability?
Yeah.
Which of the liability?
Non-current liability.
So the current tax will be shown as a liability. That is the amount that we are saying that we are going to pay to the tax authority next year. So it's a current liability. But when would the plant, when is the company going to stop using the plant? It's 5 years, isn't it?
Yes.
So it means that this difference will be happening till what? 5 years. Therefore, we are making the provision to the useful life, to the end of the useful life of the asset, which is 5 years. Therefore, the deferred tax should be treated as non-current what? Liability. Because we are going to pay this particular part to the tax authority in the future. So this will be non-current liability. Non-current liability. So deferred tax is treated as a non-current liability or non-current asset. Non-current liability or non-current asset. Whenever the current value is higher than the tax base, it means that the company is going to pay the portion of the difference, a tax on a portion of the difference in the future. Make provision for that particular payment that you are going to do in the future, because you have actually incurred that particular cost today. So make provision for it. That is the deferred tax. Current tax is current liability. Current tax will be treated as current liability. All right. So that is basically what they are asking us. The explanation is that, okay, since the depreciation rate is different from the capital allowance rate, there will be an issue of deferred tax, which is the difference between the rates, 30 and 20, that is 10%. Therefore, the company must make provision for the deferred tax elements. How do we find deferred tax? Deferred tax is calculated as the carrying value. Deferred tax is calculated as a tax rate multiplied by the temporary difference. How do we calculate the temporary difference? You show the workings. Temporary difference is equal to carrying value minus what? The tax base. After that, then you multiply, then you know your deferred tax. Deferred tax is adjusted against what? Current tax. So you have to come and add it to the current tax to know the total tax that you send to statement of profit or loss. In the statement of financial position, the current tax will be shown as a current liability, whereas the deferred tax will be shown as what? A non-current what? Liability. That is what they're asking you. Explain the term temporary difference. What is meant by temporary difference? Ibrahim, what is meant by temporary difference?
Please, the difference between the carrying value and the tax base.
Okay. Temporary difference is a difference caused by those items that are allowable for tax purposes before different accounting period. Yeah.
Please, what about the P&L? How are we treating it?
The P&L, we send a total there. This one, we add the deferred tax to the current tax, going to be the 28,875.
Okay, thank you.
Are you okay?
Yes.
All right.
Yes, thank you.
If you have time, go and read that particular portion. We don't have time. I want to finish 36 today, so let's move on fast. So basically, that is all about deferred tax. Okay. If the carrying value is higher than that one, it will be an expense. So add it to the current tax. But if the carrying value is lower than the tax base, it means that the company is charging a higher depreciation. And the company will not be charging depreciation again. Meanwhile, the tax authority will be giving them capital allowance. So they will be enjoying some benefit in the future. So that particular benefit is what we call the deferred tax assets. So if you make this thing, it will be treated as an income. It will be treated as income. Then you subtract it from the current tax and you show it as a non-current liability, non-current asset, which will be a deferred tax asset. Let's come to issue with deferred tax impact in other comprehensive income, which we call the revaluation. Okay. The first thing that you have to know is that the tax authority does not consider what? Revaluation of assets, isn't it?
Yeah.
Whenever you revalue your asset, the tax authority will not take that into consideration. Okay. But what will happen is that we are just assuming you want to pay tax on the revaluation gain, what would have been the tax that we pay? That is what we are saying the deferred tax. That is why we are saying the deferred tax. So deferred tax on the revalued assets will not go to P&L. It will go to other comprehensive income because the revaluation surplus is not a P&L item and it's not even considered for tax purposes. The tax authority is not going to, okay, your asset is having a value of 30,000. In our book, you are having 20,000. So now you have revalued the asset to 40,000. So you say that, okay, you now have a value of 30,000 with us. No, it's not like that. They will still be carrying the asset as 20,000. So what will happen is that if you are calculating your deferred tax, the 30,000 against 20,000, that one was allowable for tax purposes before the revaluation. So the 10,000, which was the difference, will now be for P&L. You calculate the tax rate on it and send it to P&L. The remaining 10,000, because the difference at the end of the day, the difference will be 20,000. But this 20,000, 10,000 is for revaluation, 10,000 is for profit or loss. So you have to share the difference. 10,000 will be for profit or loss because that is the original temporary difference. Calculate your tax rate on it. The 10,000, which is caused by the revaluation surplus or the revaluation of the asset, calculate your tax rate on it as a deferred tax, but send it to other component, other comprehensive income, not profit or loss item, not profit or loss item. So whenever you revalue your asset, the revaluation will not be taken into consideration by the tax authority. But we are just assuming that in case we want to pay tax on the revaluation surplus, what should have been the tax? So let's make provision for that particular tax. That is the case of the revaluation of assets. That is the case of the revaluation of assets. So we pick a question with a revaluation of assets. All right. Okay. Let's read the tutorial question 1. That one, right answer is there. Let's forget about that one. Let's read another question on that. If you have time, go to the answer. Okay, let's look at the WS. Who is reading?
Okay, I read.
Okay.
WS revalued its property, plant, and equipment upward by 100,000 cedis for the first time on 31st December 2015. Its reporting date. Prior to the revaluation, the current value of the property, plant, and equipment was 850,000, and the tax base was 625,000. SW tax rate is 25%. Its deferred tax liability brought forward in respect to property, plant, and equipment was 62,000.
Okay.
Required. Prepare journal entry required to record the movement in deferred tax in the year ended 31st December 2015 in the financial year statement of WS Limited.
Okay. So they are saying that WS has revalued its property and plants, its property, plant, and equipment upwards by 100,000 for the first time. So it means that a new revalued amount of the asset is what? 100,000, isn't it? All right. That is the reporting date. The 31st, 2015 is the reporting date. Prior to the revaluation, the carrying value of the property, plant, and equipment was what? 850,000. The tax base was what? 625,000. So assuming the asset was not revalued, what should have been the temporary difference? Assuming the asset was not revalued, what should have been the temporary difference?
225.
It will be
225.
225, isn't it? All right. But right now, the asset has been revalued. What is the new value of the asset now?
100,000.
600,000.
So carrying value is what? 100,000. Carrying value is 100,000. Is it 1 million or 100,000?
It's 100,000.
It's supposed to be 1 million. It's a mistake.
Oh, okay.
So 1 million. So our tax base is what? On the question, what is our tax base? 600 what?
It's 25. 625.
So what is the temporary difference now? What is our temporary difference?
375.
Okay, these 375, some are relating to revaluation, isn't it? And some are relating to profit or loss. So we have to come and separate the two. Okay. Assuming the asset was not revalued, what should have been the actual temporary difference? Assuming the asset was not revalued.
225.
it should have been 2 what?
5.
225, isn't it? All right. Let's look at what is the revaluation surplus over here. What is the revaluation surplus from this particular question? The carrying value is 850. The revalued amount is 1 million. What is the revaluation surplus?
150.
150.
150.
Okay.
150.
Add 150 to 225. Let me see something.
$375.
375, isn't it? So it means that this temporary difference, 225, is for profit or loss. That means the temporary difference if the revaluation was not done. And this is relating to other component of what? Equity. That is the revaluation surplus. So the deferred tax, this is how we are going to calculate the deferred tax now. We calculate it for revaluation surplus, which is the 150, and we also calculate on this one, then we send it to P&L. So this 375 will be break down into 2. Assuming the revaluation was not done, what should have been the temporary difference? That is the actual temporary difference without considering the revaluation. That is the difference between the tax base and then the carrying value. That is allowed, that to create a deferred tax that will send to P&L. But after the revaluation, our temporary difference is now 375. It means that our revaluation is causing a difference of 150. It's causing a difference of 150. So this revaluation surplus will not be sent to profit or loss. It will be sent to OCI. So therefore, let's calculate the tax implication on it and send it to OCI. So what we are going to do is that our deferred tax will be calculated in two folds. The first one is 0.25. Our tax rate is 0.25 times the first one is 225, isn't it?
Yes.
What are we getting?
$50.
It's what?
56,250.
57,
56,250.
56,250. Okay. Let's count to the one relating to, this is for profit or loss, isn't it? Let's count to the one relating to other components of equity. I say other components of equity, other comprehensive income. It will be
150,000.
0.25 times 150, isn't it?
Yes.
And that will give us how much?
$37,500.
37,500.
37,500. Okay. Okay. But what did the question say? Its deferred tax liability brought forward in respect of property, plant, and equipment was what? 62,000. This balance, was it relating to P&L or other comprehensive income? The 62,000, is it a deferred tax relating to P&L or other comprehensive income? The opening balance on deferred tax liability accounts, is it relating to P&L or other comprehensive income?
It should be both.
No,
Other comprehensive income.
no,
Should be P&L.
no. Okay, it's supposed to be 3, but since the 2 are no, it will be P&L. Look at this question. The property and this one was valued for the what? Was valued for the first what? Time.
For the first time, yes.
So it means that there is no balance relating to revaluation. We don't have any revaluation reserve because this is the first time that we are revaluing our assets. So any balance on the deferred tax asset will be the one that we are doing for the difference between the tax base and then the carrying value, which is the P&L. So this 62,000 over here is relating to P&L.
Sure.
Are we okay?
Sure.
Okay. But what is the deferred tax now for P&L? What is the new deferred tax now? What is the new deferred tax now? On the deferred tax that we have gotten on 225,000, what is the deferred tax now?
56, 250.
What is happening?
56, 250.
So what is happening between the two? 62 and 56. What is happening?
Okay. It's reducing.
So what do we do?
You look for the
After
difference
that-
and then add it.
The difference is what?
This is
The differences.
250, 500. This is 250. Difference will be 6,250.
6,250.
No. Let me confirm.
Okay.
It should be
62,000 minus
5750.
5750. Okay.
Yes.
This 5750, is it a reduction or increase? We are making a provision of 62,000. Now we are saying that the provision should be 56250. It means that we have over provided, isn't it?
Yes.
So this 5750, if you are going to adjust it against our current tax, are we going to subtract what we add?
We subtract.
We subtract because this looks like an income, isn't it?
Sure.
Yes. So we go and subtract this from the current tax. We go and subtract this one from current tax, but this one we send it to other comprehensive income as deferred tax. But in all, your total deferred tax that you are going to show in the statement of financial position will be the one relating to what? Profit or loss plus the one relating to what? The other comprehensive income. Or if you like, just calculate your 25% on the total temporary difference. That will be the figure that you send to the statement of financial position. So the statement of financial position deferred tax will be deferred tax relating to the P&L plus the deferred tax relating to the other comprehensive income. All right. Let's look at losses. Let's look at deferred losses. Let's look at deferred losses. Okay. Okay. People doing advanced tax. You know that for tax, when a startup company is making losses, the tax authority will allow them to what? To subtract this particular losses from their subsequent what? Profit, isn't it?
Yes.
They will allow them to carry over the losses. They will allow them to carry over the losses. What would be the implication of this? It means that that profit that, okay, let me show this. If we are making a loss of 2,000 and in the future our profit after everything is 20,000, we should have paid tax on the 20,000, isn't it?
Yes.
But since we are allowed to deduct our previous losses, we will come and subtract what?
The 2,000 from
2,000
the
and half
20,000.
18,000. We are going to pay what? Less tax, isn't it? It
Yes.
means that the tax on the 2,000 we are not going to pay. So we are enjoying a benefit on this. This is something that the tax authority is giving to us. We deserve it. So in this case, we normally make provision for those losses that we are going to subtract. We are going to subtract from our profits. The losses that we are going to subtract from our profit. Those losses will give us a benefit, will give us a future benefit. Therefore, deferred tax will arise on this because the losses are allowable for tax purposes. So when we are subtracting the losses, it is going to reduce our tax liability in the future. Therefore, that is a benefit to us. So we create what we call deferred tax assets. Since it's a benefit to us, we create what we call deferred tax assets. But what normally happens is that you have made a profit, you have made a loss of 20,000, but you are telling the tax authority that you can only in the next 3 years, we can only make a profit up to the value of 15,000. You can only make a profit up to the value of 15,000. will you be able to deduct all the 20,000 losses?
No,
You can only deduct what?
15.
15,000, because you are telling us that the profit that you can make within your capacity is 15,000. So it's only the 15,000 out of the 20,000 losses that you can be able to subtract. So deferred tax must be created on the 15,000 losses that you create. You are going to subtract. You can't tell us that you have made a loss of 100,000, but you are going to make a profit of 80,000, but you are going to subtract all the 100,000. What are you going to use to write off the 20,000, which is the excess? Are you getting my point? So we only make the deferred tax asset, the provision for the deferred tax asset, based on the amount of profit that the company is certain to make into the remaining future, or the amount of profit that they can make. We only made the deferred tax provision on that. But if the company is sure that, okay, we are going to make a profit of 120, it means that all the losses can be written against what the 120, isn't it?
Yes.
In that case, we create a deferred tax on all the losses. Okay, so let's look at deferred tax assets. Deferred tax asset is recognized on unutilized losses carried forward, as there will be a future tax benefit when the losses are offset against future profits. However, the assets can only be recognized to the extent that it is probable that the future taxable profit will be available against which losses can be utilized. I'll explain that already. You can't be making a loss of 100,000 and you are telling us that you can only make a profit of 80,000 and you are going to subtract all the 100,000. It doesn't make sense. You can only make the provision on the amount of profit that you are certain that you are going to make over the period. But if you can make a profit higher than the available losses, then you can make provision on all the losses. Let's move on. Let's look at this question. Who is reading? Tutorial question.
Okay, I read.
All right.
Simpson Limited has only been trading for 2 years and has not yet made a profit. It has losses available for carry forward of 75,000. It expects to make profit of 25,000 cedis per annum for the next 2 years, but is not in a position to estimate profits beyond this. The current corporate income tax is 30%. Required, prepare the journal entry to record the deferred tax arising on the losses.
Okay. So what is the total loss?
The
75,000.
But what is the value of the profit that they are saying they can make?
25.
It's 25,000
Per annum for the what?
The next
for the
2
next
years.
2 years.
So what will be the total profit that they will make?
50,000.
50,000. So are they going to make the provision on all the 75,000 or they will make it on the 50,000?
They will make it on the 50,000.
On the 50,000.
Only the 50,000. And that will be represented as what? A deferred tax asset, which will be subtracted from our current tax. So this is the thing. Deferred tax assets account is 30%, which is 15,000. Profit or loss will be 15,000. So if it is a deferred tax asset, it's an income, it's a benefit to us. So we write it off against the current tax. We go and subtract. But if it is a liability, it means that we are going to pay to the tax authority. So we treat it as an expense. We add it to the current tax. That is the deferred tax issue. Let's look at, we have done the impact of this one. Let's look at special cases before we solve some questions. Let's look at special cases where we have issues of deferred tax. The first one is group accounts. Okay. The first one is group accounts. The IFRS 13, which is a fair value measurement, states that at the date of acquisition, all the assets and liabilities of the subsidiary company must be measured to what? Fair value. Must be measured to fair value. Before we proceed, whenever a company values land, don't say land is not depreciable, so we are not going to create deferred tax on the land. If the land is 20,000 in the books of the company, what will be the value of the same land in the books of the tax authority? If the value of the land is 20,000 in the books of the company, what would be the value of the same land in the books of the tax authority?
20,000.
It will be what? 20,000, but just that they will not give capital allowance on it. Are you okay?
Yes.
All right. But if the company now values the land to 30,000, can you see a difference?
Yes.
The difference is what?
10,000.
10,000.
So assuming we are to pay tax on the gain, what is the tax that we have to pay? Then we have to create deferred tax on the revaluation gain and send it to other comprehensive income. We will not send it to profit or loss because land is not depreciable. So it will not have any tax consequences on the future tax that we are going to pay because it's not depreciable. It's not depreciable. But if you do revaluation, the revaluation reserve will make the carrying value of the land in the books of the company higher than in the books of the tax authority. So you make provision on the revaluation gain and send it to other comprehensive income, not P&L, not P&L. So don't say land is not depreciable and you have a question that they say the land has been revalued. No. Though land is not depreciable, but the value of the land in the books of the company is the same as in the books of the tax authority. Just that the two of them are not going to give capital allowance or they're not going to charge depreciation on it. So if there's a revaluation, the gain will cause the carrying value in the books of the carrying value of the land in the books of the company to be higher than in the books of the tax authority. So make a deferred tax provision on the revaluation gain and send it to other comprehensive income. All right. Okay, that is just by the way. Let's come to this place. The fair value measurement says that at the date of acquisition of the subsidiary, the assets and liabilities of the subsidiary must be what? Revalued to their fair value. So sometimes you see those doing corporate reporting, you are here to do consolidated financial statement, but you have done basic console. Those doing financial reporting, you are still doing console. You will see that they will say that at the date of reporting, the fair value of the assets and liabilities of maybe the subsidiary company are equal to their carrying value, except with the following exceptions. Then they will say the fair value of the plant is 10,000 higher than the what? The carrying value. So assuming the carrying value is 100,000, the assumption is that this is the same in the books of the tax authority. So if now they are saying that it's 10,000 higher than the carrying value, it means that in the books of the company now, it will be 110,000. But in the books of the tax authority, it will be what? 100,000.
100,000.
There is a difference of what? 10,000.
10,000.
Which will create a deferred tax, but not deferred tax to P&L. It is created by revaluation, not P&L item. So we send it to other comprehensive income. So sometimes the question, all the console questions that have been coming, they don't talk about this issue of deferred tax, but they can give you a tax rate and they say the fair value adjustment will create a deferred tax consequences or something. What you are going to do is that at the date of acquisition, use your tax rate to multiply the revalued amount, the adjustment, and treat it as a non-current liability, subtract it from your net asset, both at acquisition and at reporting, because you are doing this fair value adjustment at the date of acquisition. But I don't think they are going to give you any question like that. So this is the first case. This is the first case. Whenever you revalue an asset, it can be downwards, upwards. That particular value will automatically be higher than the tax base or be lower than the tax base if it is lower fair value adjustment, if it is downwards, that is the first case. That is the first case. The next case is the goodwill. Upon acquisition, what will happen? The parent is going to realize a goodwill. That is when the parent is paying more than it should pay for the value of the shares that they are buying. So if the value of the shares that the parents are buying is 10,000 and the parent is now paying 120, it means that they are paying more than they should pay. So the difference is what we call technically as goodwill. What will happen? If there is an addition of goodwill to the asset, it means that the asset will be, the value of the asset in the books of the company will be different from the tax base, because the tax base or the tax authority is not going to recognize the goodwill. Are you okay? The tax authority is not going to recognize the goodwill. So if the value of the total asset of the company was 10 million, assuming this was the same for the tax authority to 10 million, but you are now having a goodwill. Goodwill is an asset. So our value will now be, let's assume this is 200,000. The new value of the company will now be, the value of the asset will be this one, but still the tax authority will be having 10 million. But what happens? Goodwill is not something that is allowable for tax purposes, isn't it? So the difference that the goodwill is creating is a permanent difference. So we don't do any deferred tax issue on it, because it will not create any future tax issues, because it's a permanent, it's caused by a permanent difference, or all those differences are permanent that are not allowable for tax purposes will not be adjusted for deferred tax. The next item is provision for unrealized profits. Provision for unrealized profits. Provision for unrealized profits. At the date of consolidation, any sale between the group, assuming the parent is selling to the subsidiary 2,000 and they are making a profit of 500. At the end of the day, the subsidiary is telling us that they were able to sell only 1,005 of the goods. It means that there's a portion of the profit in this 500 which will not be realized, isn't it? Because you can only realize all the 500 profit when you sell all the 2,000 goods. Now the people are saying that they didn't sell all the 2,000 goods. It means that there's a profit element on the 500, which is relating to the goods that were not sold, 500 goods that were not sold. There's a profit element in this 500, which is not realized, because which is relating to the 500 goods that were not sold. So what we'll do is that the parent, at the date of consolidation, the parent or the subsidiary has to remove that particular profit there. But what do we do at the date of acquisition? What do we do at the date of reporting? We don't adjust their tax figures. We just take the tax figures and add them. It means that the company or the parent or the subsidiary estimated their tax considering all the profit which was on the 2,000. So they are estimating their tax based on all the 2,000 goods that they are selling, that they are going to make a profit of 500. So they estimate the tax considering all the 500 profit. Now, portion of the profit will not be realized. The portion, the tax element that is related to the profit that will not be realized should also be removed. But we don't do that. We don't do that. We just add the two tax figures and leave it like that. We don't adjust that profit that is relating, the tax that is relating to the profit that is yet to be earned. We don't subtract it from the tax. We don't subtract it from the tax. So under normal circumstance, the unrealized profit should also create a deferred tax credit, which will be a deferred tax asset. But we don't do that. And I'm here to see a question that there will be the money for that. So those are the special cases for deferred tax. Those are the special cases for the deferred tax. Let's solve two more questions. Then we say that is the end for deferred tax. So the first question that we solve is the last sitting question. Let's look at the last sitting question, question 12.
Question 12.
Yeah.
Should I read?
Yes, read the question 12.
The financial accountant of Abodi Limited is finalizing the financial statements of Abodi Limited for the year ended 31st August 2021. The following items are being considered for the deferred tax purpose. 1. At year end, Abodi Limited property, plant and equipment had tax base and carrying value of 72 million and 95 million respectively. 2. The company's provision for decontamination cost was 11 million, appropriately what discounted at the year end. Decontamination costs are taxed deductible when paid. 3. The company had inventory with carrying value of 24 million. This did not agree with the tax base because of the 3 million write-down value for the obsolete items. Tax relief is only granted for inventories upon sale. The company incurred 15 million cedis in respect of new software development during the year, which was capitalized and will be amortized over the next 5 years. Full year's charge is required in the first year of completion or purchase. This cost was deducted in the current year for tax purposes. The company is liable for income tax at 30% required. Compute the company deferred tax liability at 31st December 2021.
Okay. So all the items presented over here, you can see that the question, the examiner was giving you that all of them are allowable for tax purposes, isn't it?
Yes.
So the question now is you have to determine which of them will be a tax credit to the company and which of them will be a tax expense to the company. Let's take the first one. At year end, property, plant, and equipment had tax base and carrying value of 72 million and 95 million. Is the tax base higher than the carrying value, or the carrying value is higher than the tax base?
Carrying value is higher than tax base.
So we look at the computation of deferred tax. Computation of deferred tax. Let's look at the computation of deferred tax. So the first item, let me put a currency sign here in million. So the carrying value is higher than the what?
The tax base.
The tax base. So that would be a taxable difference, isn't it?
Yes.
What is the difference?
95,000 minus 72,000.
And that would the difference would be what?
Okay.
20. I can hear you.
She said
23 million, isn't it? 23 million, right?
23,000.
23.
Okay. So what will be our deferred tax on that? It will be 0.3 times the difference. The difference is a temporary difference, isn't it? What is the figure there? What will be the figure? 0.3. The company is liable for income tax at 30%. So that is the tax rate. And the difference between this one is the temporary difference. Is a temporary difference. Is a temporary difference. So what is the answer there? If you multiply, what are you getting? What are we getting after multiplying?
6,900. 6,900.
6,900. So we are doing it in millions, 6.9. Am I okay? Would that be an expense or income? Would it be a deferred tax expense or deferred tax?
It's expense.
It's an expense. Okay. Let's come to this one. The company's provision for decontamination cost was 11 million, appropriately discounted at the year end. Decontamination costs are tax deductible when what?
Paid.
So it means that since the company hasn't paid this particular amount of money, the tax authority cannot deduct it from their taxable income or chargeable income, isn't it? So it means that when they pay this amount, it will be subtracted for tax purposes and they are going to enjoy that particular tax on it, isn't it? So for this, it means that whenever they pay the 11 million, they are going to enjoy some tax on it. The company, the tax authority will subtract it when they pay this particular amount. So the tax benefit that they are going to enjoy, would it be an expense to the company or it will be an income?
It will be an expense.
No. To you, for now, to the company, the cost is an expense. But the tax authority is saying that, okay, if you pay the money, we are going to subtract it from your profit before we charge you tax.
Okay. Okay.
But you are going to enjoy some tax benefit, isn't it? It
Yes.
means that if you haven't incurred 11 million, the tax that you are going to pay will be higher than if you incurred 11 million.
Yes.
So in this case, this will be a deferred tax asset. How do we do that? You do the contamination cost. Even the question say is deductible. It means that you are going to subtract it before you charge the tax. So that would be 0.3 times 11 million. What are you getting? What are we getting?
3.3.
3.3 will be an income, will be a benefit. So we subtract. That is why I'm putting it on brackets. The first one is an expense. That's why I leave it like that. Because at the end of the day, we net the benefit against the loss. Then we know the net deferred tax. Okay. Let's look at the next one. The company had inventory with carrying value of 24 million. This did not agree with the tax base because of 3 million written down value for obsolete items. Tax relief is only granted for inventories upon sale. This did not agree with the tax base because of 3 million written down what value for obsolete what items. Tax relief is only granted for inventories upon what? So, in the books of the company, what is the value of the inventory?
24 million.
What will be the value of the inventory in the books of the tax authority?
It will be 27 million.
27 million, isn't it? All right. But inventory, whenever you sell the inventory, the tax authority is going to subtract it and they will give you tax on it, isn't it?
Yes.
All right. So what will happen is that we, in the statement of financial position, we are going to have inventory as 24 million, isn't it? But the tax authority is giving us additional what? 3 million, that we are not going to pay tax
3
on
million.
additional 3 million. We are going to enjoy tax benefit on additional 3 million. Would that be an expense to the company, or if in the case of paying tax, would that be an expense? Would that be an additional tax, or it would be a tax relief? Okay, let me take it again. Let's assume that our profit is 24 million. We are subtracting, okay, let's assume that it's 100 million. We are subtracting what? 24, isn't it?
Yes.
What are we getting? 66. Okay. But the tax authority is going to subtract what? 27. And they are going to have what? 63, isn't it?
Yes.
The tax that they are going to give to you, will it be higher than this?
No, it will be lesser.
It will be lesser. So it means that the 3 million
No.
is giving you a benefit, isn't it?
Yes.
You see,
Yes.
brothers and sisters, the question was even straight. You can say the question was giving you how to treat them. They say tax relief is only granted for inventories upon sale. What is tax relief? It's not benefits. So you don't even have to do this analysis. Tax relief is only granted for inventories. It's a benefit. Tax relief is a benefit. Something given to you to reduce your what? Your tax liability. Decontamination costs are tax deductible when paid. They are saying that you are going to subtract it before you pay tax. It means that you are going to enjoy some benefit on it. So this one, the 3 million over here, you are going to enjoy a benefit. We're not going to pay a tax on that one. So what is the portion of the tax that I'm not going to pay? That is a 30% on a 3 million difference. What are we getting?
Yes.
.3 times 3 million. What are we getting? What are we getting?
You are
0.9. 0.9.
0.9. That is again, isn't it? So we net it. 0.9. The question was even straight. You don't have to think. They say tax relief is given when inventory. Okay, Jan.
But please, the inventory was not sold out.
Was not what?
that is given if only the inventory is sold, but it's not sold. So
We
how
are going
will
to sell
you?
it. So we are just making provision for the benefit that we are going to enjoy when we sell it. It's not that this is a deferred tax is a provision that we are making for things that will happen in the future, not something that is happening today. So if the inventory we are going to sell in the future, what is the value of the tax benefit that we are going to enjoy? That is what we are making the provision for today.
Okay, thank you.
Are you okay? All right.
Yes,
So it's a
I'm
provision
okay,
that we
thank
are
you.
making. It's not that that is a benefit that we are saying we are going to enjoy. We only enjoy that benefit before if we sell the inventory. But we have to make provision for that particular benefit. That is the deferred tax that we are doing. It's not that the thing that we are doing today, we are going to pay it. No. The thing that we are going to pay in the future, let's make provision for it because it will automatically incur or it will automatically incur. All right. The last one is the company incurred 15 million in respect of new software development during the year, which was capitalized and will be amortized over the next 5 years. Full year's charge is required in the first year of completion or purchase. This cost was deducted in the current year for tax purposes. Whenever you incur development expenditure, the tax authority, whenever the cost is incurred, they will write all the costs against your what? Your profits before they will charge you what? The tax for the year. But you are capitalizing this and you are saying that you are going to amortize it over what? 5 years.
5
Question
years.
say that full year's charge is required in the first year of completion. So if you are doing 5 years and we are charging full year, what should have been the amortization for? What should have been amortization for the first year?
3,000.
That would be 3,000, isn't it?
3 million. 3.
So what would be the remaining? What would be the carrying value after that one?
12 million.
12 million. But this 12 million, is it in the books of the tax authority?
No.
They are written
No.
off at once, isn't it?
At once, yes.
So it means that this 12 million will not be given to you again. So it means that you are going to pay tax for the 12 million that you are keeping. You have enjoyed it today. It will not be given to you maybe tomorrow or next year. So it means that what you are going to enjoy, you have enjoyed it already. In the future, you pay tax on the 12 million that you are keeping today. Are you getting the argument? So in this case, this particular one will be an expense because you have already enjoyed the 15 million. You have already enjoyed the 15 million. So since you are keeping it, you have already enjoyed the 15 million, but you have written 3 million out already, remaining 12 million. This 12 million that you are keeping, the tax authority will not consider them again. If you are writing it against your profit, the tax authority will not consider that. They are going to charge you tax on it. So you are going to pay tax on the 12 million. So the tax that you are going to pay as a result of you keeping 12 million, make provision for that particular tax. So we come to software development. We come to software development. We come to software development. 0.3 times what? Times 12. What are we getting?
3.6.
3.6. This is an expense. So let's now have our total deferred tax at the end. At the end. Where is that? So our total deferred tax for the year will be 6.3. That's all. That's what they're asking you for 6 months or something. That's last year, FR. All right. Complete the company deferred tax liability as at this one. So the tax liability is a 6.3. After netting all the deferred tax assets, you net them off. Okay. Let's look at the question relating to FR. Last city, FR. Question 14 was for FR.
Please, can you show the Excel sheet?
Is it?
The Excel sheet. I want to check the solution.
Okay.
Thank you.
All right. So let's look at the last question, which was for FR, last sitting. Who is reading?
Question 14.
Yes.
Sander Limited is a consumer electronics company in Accra, Ghana, which has faced a challenging year due to increased competition and the impact of COVID-19. Sander Limited has a year-end of 31st December 2021, and an audited draft financial statement reported an operating loss. Additionally, Debt Covenant Limited, based on gearings, are close to being breached by Sander Limited, and the company reached its overdraft limit. During the year, Sander Limited has included a deferred tax asset in its statement of financial position based on the losses incurred in the previous 2 years. The finance director has asked the accountant to include the deferred tax assets in full. The finance director has suggested this on the basis that Sander Limited will return to profitability once its funding issues are required. With reference to IFRS, discuss appropriate accounting treatment, which Sander Limited should adopt for the above issue.
Okay. So what we are saying is that they say their gearing ratio is not okay. They have reached their overdraft limits. That means the company is facing cash problems, isn't it? The company is facing liquidity problems, and they have reported losses over the years, and the finance director is asking the accountant to include the deferred tax in full. The finance director has suggested that this will return to profitability once the funding issues are resolved. So in accordance with International Financial Reporting Standard, discuss the appropriate accounting treatment which Sander Limited should adopt for the above issue. What do you think they should do? What do you think the accountant should do? This one is not calculation, it's a theory question. 5 marks. So you have to say your mind. It's not something that you say that if you say it, I will say it's wrong. No, this is not calculation. My people, Kevia. Kevia, are you there?
Yes, please. Yes, I'm here.
Yes. I hope you're okay with the deferred tax, isn't it?
I'm on it.
Is that?
Yes, please.
Okay, since you're okay, answer this question. The first question is, must the deferred tax be recognized in full? Must the deferred tax relating to the operating losses recognized in full?
Yes.
Only if their profit is up to that.
If they can make profits up to the level of the operating
Amount
loss
of
that they
loss.
are currently having, isn't it?
Yes.
But looking at the information given, would a company be able to make profit at all?
No.
No. Are you getting the argument? This company is
Yes.
likely to be liquidated or to go out of business.
Yes.
So their gearing ratio is too high. It means that if the gearing ratio is too high, it means that the company is going to use more of its profit to settle what? Interest. And if you are using more of your profit to settle interest, it means that you will not have enough profit against which you are going to write off your operating loss. The bank limit is, they have even reached their overdraft limit. They don't have cash. They can't go for loan and run business. The business will automatically be out of business. The company will automatically be out of business. So given all these conditions, there is no assurance. There is no evidence that a company will come back to its profitability state. Therefore, the deferred tax should not even be recognized at all. Because there is no assurance, there is no evidence, there is no information telling us that, okay, in the future, the company will come back to its profitability stage or return to its profitability state, because you don't have cash to run the business. You have more debts. More of your profit to be used as interest. This one that the accountant is even recognizing the deferred tax is something that is supposed not to do. Given the above information over here, deferred tax should not be recognized at all. The company has no prospects. There's no prospect. There's no future for the company. And you can't make profits. So if you're not going to make profits, you can only realize or recognize the deferred tax assets to the extent of the profits covering the operating loss that you are sure that you are going to make in the future. So you can only write the deferred tax against the profit that you are saying that you will be making in the future. Looking at the state of this particular company, no prospect, no future, no profit to be made in the future. So deferred tax should not be recognized at all in the first place. So if you want to ask this, if you want to answer this question, you first state what the standard says about deferred tax asset relating to operating loss. What does the standard say? The standard says that according to IAS 12, deferred tax relating to operating what? Losses or unutilized losses. The standard says that you can only make a provision for deferred tax to the extent that the company is sure, to the extent that the company is sure that future profit will be available against which the operating loss will be what? Written against. But looking at the state of this particular company where their gearing ratio is close to being breached, they are reached their overdraft limit. It means that the company has no cash. More of the interest will be used as profit, and the company is not going to make profit in the future. The company has no prospect. It is likely the company might go bankrupt. The company might get liquidated in the future. Therefore, the finance director or the accountant should not even make provision for the deferred tax assets. Very simple. So this is CR. Question 14. CR. Last sitting. Question 12 was for FR, last sitting. Ladies and gentlemen, we have come to the end of IAS 12, income tax. All right. I want to introduce you to IAS 36, which is impairment of non-current assets. All right. Impairment of non-current assets. Okay. The idea about impairment is where you have a car. You have a car, and the cost of the car is 20,000. You're now involved in an accident with the car. What will happen? You automatically realize that the value of the car will reduce, isn't it?
Yes.
If the value of the car now is 15,000, what is happening? The value of the car is reduced by 5,000 as a result of the accident, isn't it?
Yes.
And that is how much?
5,000.
5,000. And the accident is going to reduce the efficiency of the car, isn't it?
Yes.
In that case, we say that the car has impaired by 5,000. So you don't just stand up and say you are going to conduct impairment. If your phone fell down, okay, you can say the standard is not for individual anyway, but you can say you are practicing the impairment that you have learned. So you say that, okay, the phone has fell down. So it means that the phone will not function well. Or if I want to sell this phone, I cannot sell it at the amount that I bought it. Even if it is a new phone that you bought the same day and the phone fell down and the screen cracked or something, you can't sell it at the same amount, isn't it?
Yes.
So if it is 1,000 that you bought it and someone now want to buy it at 800 cedis, you are losing what? 200.
200.
That 200 is what we call what? Impairment. So before you test for
Impairment loss.
impairment, there should be a condition saying that the capacity of the asset will reduce or the efficiency of the asset will reduce. Are you okay?
Okay.
You bought, let me say you bought you bought a software that is 5,000, and the government has passed a legislation that nobody in the country should use the software again. Can you get somebody to sell the software to?
No.
It means that the software is worthless, isn't it?
Yeah.
So if someone wants to buy this software, 1,000 cedis, it means that you are losing what?
4,000.
This 4,000, you're losing this 4,000 as a result of the legislation passed by the government, isn't it? So we can
Yes.
say that the software has impaired by what? 4,000.
4,000 cities.
As a result of the legislation being passed by the government. So if you want to talk about impairment, we only test for impairment when there is a condition showing that this asset might impair. If there is
When there's a cause for it.
If there is an accident, the car involved in an accident, then it means that the efficiency of the car is going to reduce, the capacity of the car is going to reduce. So therefore, let's test for impairment. Let's see whether the asset has reduced in value. That is basically about impairment. But why should we carry out an impairment test? After the car involved in an accident, you are not going to revalue the asset. You are still going to be carrying the car at what? 20,000, isn't it? In the books of the company, the car will still be at what? 20,000. But the 20,000 over there, is the original representation of the value of the car?
No.
No, since the car involved in accident, it means that the value of the car is going to what? Reduce.
Reduce.
So we should carry out an impairment test. Why do we carry an impairment test? So that we will not represent the asset, the car, at a value higher than the value we should get from it. That is the idea about the impairment. We are doing this so that we will not be saying that the car is 20,000, though the car has involved in accident. The value cannot be 20,000 again. The value will be lower than 20,000. So let's carry out an impairment test and bring the asset now to its actual value. That is the value after the what? The accident, which will be 15,000. So we do impairment to ensure that the asset will not be carried in the financial statement higher than the value that the company will recover from selling it or using it. So 20,000, you have an accident, you are still saying that the value of the car is 20,000. It doesn't make sense. So carry out an impairment test to bring the asset to the value, which is the original representation of the value of the asset as at the day that you have that particular asset. That's why we do impairment. We do impairment to ensure that the value of asset in the statement of financial position will not be higher than the value that you should have gotten from it if you should sell it or if you should continue using it. So under impairment, we look at three issues. We look at carrying value, which is the normal way, cost minus accumulated depreciation less any impairment. Then we look at what we call recoverable amount. The recoverable amount in this case is the 15,000 I'm talking about. But under the recoverable amount, we have two. We have the net realizable value or the fair value less cost to sell. Fair value less cost to sell. And we also have what we call value in use. Okay. If you are talking about the recoverable amounts, okay. Someone is saying that if I want to buy the car, I'll buy it 15 cedis. But someone told you that if you should continue using the car, you are going to get 16,000 in all. Which of these advice are you going to get? Are you going to sell it for 15,000 or you continue using it and enjoy the benefit of 16,000?
You continue using it.
And you enjoy the benefit of 16,000, isn't it?
Yes.
And in this case, the asset will impair by 4,000, isn't it? Original value is 20,000. If you continue using it, 16,000. So the asset will impair by 4,000. So if you talk about recoverable amounts, we normally pick the higher of the net realizable amounts or the value in use. The net realizable value is if you want to sell the car today, you sell it for 17,000. But you are going to sell the car through an agent. An agent will charge you an agent fee of what? 2,000.
2,000.
So technically, the value that you are going to get from the car will be how much?
15,000.
And that 15,000 is the net realizable value. The selling, the fair value less cost to sell. The cost to sell is the cost that you are incurring to sell the asset, which is the agent fee.
Okay.
You can also incur a transportation cost to send the asset to whoever want to buy it. You are incurring that transportation cost because you want to dispose the asset. So that cost, we net it against the amount that we are selling the asset to get the net realizable value. The value in use is the value that you are going to, the benefit that you are going to generate when you continue using the assets. But under this particular value in use, what we normally do is that they will give you the cash flows that the asset will generate for you over the future. So we present value that particular cash flows to find the value in use. So if you are talking about impairment is calculated as the carrying value compared with what? The recoverable amount. The recoverable amount is the higher of the net realizable value or the value in use. So if the value of the asset is 20,000, the net realizable value is 15,000, and the value in use is 16,000. What will be the recoverable value here? The recoverable amount. The net realizable value is 15. The value in use is 16. Carrying value is 20,000. What are you going to pick as a recoverable amount?
16,000.
You pick the 16.
So you pick the 16,000 as the amount. So what is happening?
Yes.
The carrying value is higher than the what? The recoverable amount. Therefore, the asset has impaired by what?
4,000.
4,000.
4,000.
Okay. Assuming your realizable value is 21,000 and your value in use is 16,000, what will be the recoverable amount?
21,000.
So in this case, can we say the asset has impaired?
No.
No. So whenever the recoverable
again.
amount is higher than the carrying value, the asset has not impaired. But it's only if the carrying value is higher than the what? The recoverable amount. That's why we say that, okay, we are carrying the asset as a value which is higher than the value in the market or the benefit that we should have gotten if we continue using the asset. Are we okay? So
Okay.
how do we calculate impairment? Impairment is calculated as the carrying value minus what? The recoverable what?
Recoverable amount.
We only say recall. Let's write it anyhow. The last time I wrote English was so if the carrying value is higher than the recoverable amount, then we say that the asset has impaired. But the recoverable amount is higher than the carrying value, we say that what? The asset has not impaired. So we still carry the asset as what? The carrying value. But if the carrying value is higher than the recoverable amount, the recoverable amount will now be the new value of the asset. For you to calculate the carrying value, you still have to do some depreciation to know the carrying value as at the day that you are doing the impairment test. Okay. What you should have in your head is that impairment, basically, the impairment that we are doing it for assets that are carried under cost model. We are doing it for assets that are carried under what? Cost model. If the asset is carried under revaluation model, impairment is already done. The impairment is the revaluation loss. The impairment is the revaluation loss that we are going to get because the fair value will be lower than the carrying value. So therefore, the revaluation loss is already included, but we are just calling it revaluation loss. So technically, we do impairment for only assets that are carried under cost model. All right. Impairment is an expense. Impairment is an
And then my
expense.
class,
It's an
Yeah,
expense
no,
because your
class,
asset is
we do
reducing
obey
by
to Ashabana.
4,000. This particular cost, you are not going to get it. That will go against you. It's an expense. So what says the time? 7:38. All right. Next week, we finish the impairment loss and look at another topic. All right. If we don't have any question, I want to tell you that I'm done for today.
Are we not coming back? I think it's from.
Yes, for the combined class, I'm done for today.
Oh, okay, okay, all right, all right.
All right. So if we don't have any question, my people,
Today's we are not even plenty. We are just only 20 or so.
Please, what time should we come back?
yeah, I'll put that in the group. I will let the person to set up the Zoom.
Okay.
Sorry for the lateness. The Zoom, the person, Omar was not around, so the person who's supposed to set up the room was not even there. So that caused for the delay. It's not happening again. Sorry.
Oh, the
Even
list
if I'm
wasn't
saying
too
sorry,
much.
because you don't
That's
have
all.
anything, do you have a choice? You don't have a choice. So why am I even saying sorry for you? There is a formality. I have to say sorry.
But the list wasn't too much. Just some 5, 7 minutes. So it's normal.
Okay, it's normal. I like
Thank
the way
you.
you understand things. The question will also understand you like that, and you pass. All right. I will see you in the next 5 or 10
50
minutes.
minutes.
All right.
Okay.